What is the ultimate retirement portfolio? Welcome back to the channel. That's the question we're going to answer today. This is not investment advice. The key consideration is to own what you're comfortable holding. Risk profiles are different, as are attitudes to certain asset classes such as commodity, property and bonds. So the ideal pension portfolio has different buckets, a series of pots ordered in terms of when you need access to them. You move money from longer term pots to shorter term pots as you get older, and you employ top slicing and taking profits whenever returns are above average. You withdraw or sell assets from the short term pot only. So I'm going to start with the 10 years to 30 years bucket. So this is the longest term bucket. There's a potential here to have a core portfolio and a satellite portfolio. The core could be a global index tracker, and the satellite could be something like private equity, thematic ETF, single country ETF or fund. You could put things like Fundsmith in here, Scottish Mortgage, Smithson, all sorts of stuff. If the returns of a single investment exceed its long-term average, you trim the winners and either rebalance within this bucket, so you'd buy something within the bucket that hasn't maybe done so well, or you'd move that cash into a shorter time frame bucket. So rebalancing. Since 2010 and the global financial crisis, rebalancing from equities to bonds hasn't worked, as low interest rates have kept bond returns low. So you've sold equities when they've gone up in value, only to buy bonds and see them still lose more and more money. So be careful what you rebalance into. But when we're doing this, we're ringing the cash till rather than selling on a stop loss. And that mental reframing is really powerful for your portfolio. So next we look at the 3 years to 10 years bucket. So the aim here is wealth preservation, and I've done a video that looks at various wealth preservation investment trusts. These have multi-assets within them, so they have commodities, value stocks and bonds, often inflation protected bonds. And they pivot between these asset classes as the economy moves through its cycle. So with these sorts of assets, you look at the maximum drawdown. So that's the most you could have lost if you bought at an all-time high. And then the duration of that drawdown during periods of market stress. So you want something with a drawdown period clearly of less than 3 years, because you might access within that time frame. And you need your asset to have a good long-term track record. So it needs to be in existence prior to the global financial crisis, so prior to like 2007. You could also have maybe a high yield tracker in here, a high yield ETF, or a dividend hero investment trust. So these would be value options, but they're backed up by cash payments being made to shareholders to prove that the company is actually generating cash, rather than just sitting on a low PE ratio but not able to return any funds to shareholders. So here is the classic tortoise and the hare. So the hare is Scottish Mortgage, and in 2019 starts off slightly in the lead, pulls back a bit, then roars ahead after coronavirus, only to come crashing down, and it's challenging capital gearing as to who's going to be the biggest loser. But capital gearing just really slow and steady. There is a decline in March 2020, but you'd hardly notice it. So that's the one to have within a wealth preservation portfolio. So now a quick look at bonds. So this is Vanguard that I don't like and bonds that I don't like. Put them together, what you get, a 20% loss in 6 months, going from £24 down to £20. So bonds aren't necessarily a safe shelter for your money. So be very careful if you're looking to invest in bonds. Finally, the 0 to 3 years pot. Okay, so this unfortunately has to be either cash or premium bonds. You have to have the capital certainty. It's 3 years expenses less any guaranteed income such as a state pension. And now you have the advantage that you can look through a market decline. You're not a forced seller. You've planned what you want to do in the next 3 years. You've costed it. That plan is fully funded and it remains intact despite the market drawdowns. This gives you so much more confidence. Cash is a necessity. It's only excess cash that is trash. So for a 30-year horizon, in summary, the portfolio is constructed for longevity and not growth. If you need growth, then maybe you shouldn't have retired. The 0 to 3 years, capital certainty. 3 to 10 years, wealth preservation. 25% of your portfolio, 10% is in the 0 to 3 years pot. Then the balance, which is this disciplined growth with the top slicing to avoid things getting too much out of kilter, to avoid having too much in any one fund, that's about 65%. So if you want more details as to, well, how do I really put this together? Can you give me more examples of things I should put in there? Can you show me a framework of how I can rank different assets? Then I can act as a sounding board to help you flesh this out in more detail and build a unique solution to you. So please subscribe to the channel, like it, let me know your comments. You can contact me via Gmail or follow me on Twitter @Ian Shadrack, and you can message me through that.